Good afternoon. Since the previous meeting of the Monetary Policy Committee, the global economic and political landscape had changed significantly following the US presidential election. The high degree of uncertainty surrounding the economic policies of the new administration is expected to persist for some time, creating a more challenging and volatile environment for emerging markets in particular. Higher US long bond yields, along with expectations of a tighter stance of monetary policy by the US Fed than previously expected, have contributed to the reversal of the recent positive sentiment towards emerging markets. The prospect of rising protectionism and its implications for world trade are also a concern. These developments have also affected capital flows to South Africa, with implications for the rand and bond yields. Domestic growth and inflation dynamics have remained more or less in line with expectations, but risks to the inflation outlook have increased moderately. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 6.1% and 6.4% in September and October, respectively, compared with 5.9% in August. The October outcome was marginally above the bank's forecast. Food price inflation accelerated further to a recent high of 12%, with the category of food and non-alcoholic beverages contributing 1.8 percentage points to the overall inflation outcome. Goods price inflation measured 7.1% in October, up from 6.6% in September, with non-durable goods inflation rising to 7.6%. Services price inflation increased from 5.6% to 5.8%. The bank's measure of core inflation, which excludes food, fuel and electricity, measured 5.7%, up from 5.6%. Producer price inflation for final manufactured goods measured 6.6% in September and October, down from 7.2% in August. The main contributor to October outcome was the category of food products, beverages and tobacco products, which contributed 4 percentage points and reflects the continued impact of drought on food prices. The latest inflation forecast of the bank is broadly unchanged over the forecast period, despite a moderate upward adjustment to the food price forecast in the later quarters. The annual averages are unchanged at 6.4% for 2016 and 5.8% and 5.5% in the coming 2 years. Inflation is expected to peak at 6.6% in the fourth quarter of this year, marginally lower than in the previous forecast, with a sustained return to within the target range still expected to occur during the second quarter of 2017. The higher food price assumption is offset by a slightly more appreciated exchange rate assumption. Core inflation is expected to average 0.1 percentage point less in each year of the forecast period compared with the previous forecast at 5.6% this year and 5.5% and 5.2% in 2017 and 2018. Core inflation is expected to remain within the target range over the forecast period, with a peak of 5.8% in the final quarter of this year. Annual inflation expectations of economic analysts, as reflected in the Reuters Econometer survey conducted in November, are broadly unchanged since September and are similar to those of the bank. The median forecast for the current and next 2 years are 6.3%, 5.8%, and 5.6%. The bond market expectations implicit in the break-even inflation, that is the yield differential between conventional government bonds and inflation-linked bonds, increased in the wake of the recent depreciation of the rand. They remain above the upper end of the inflation target range. The global outlook has become increasingly uncertain during the year following the UK decision to leave the European Union and the outcome of the US presidential election. While the new policy direction in the US is unclear, the markets have interpreted the outcome as being positive for US growth in the short run, with commitments to tax cuts and higher fiscal spending on infrastructure. These policies are expected to result in higher growth and inflation, particularly against the backdrop of an increasingly tight labor market. Nevertheless, the timing and the extent of the expenditure boost is highly uncertain at this stage. While an increase in infrastructure expenditure could be positive for commodity prices, other aspects of the possible new policy direction are likely to have an adverse effect on emerging markets. These include a possible more aggressive tightening of US monetary policy in response to higher inflation and growth, which could also reduce the multiplier effect of fiscal expansion. Together with the recent sharp increase in US long bond yields, the possibility of such actions has led to a reversal of capital flows to emerging markets, reminiscent of the market reaction of the so-called US taper tantrum of 2013. The impact on emerging market currencies and bond markets, including South Africa, are already evident. During the high degree of uncertainty, the financial markets may have overreacted. A further concern for emerging markets is the potential change of trade policies that may impact on existing trade treaties, as well as unilateral increases in tariff protection in the United States. The outlook for emerging markets has therefore become more uncertain. The lingering concerns about the sustainability of the recovery in the Chinese economy have been revived by the possibility of tariff increases on Chinese exports. Countries with strong direct trade links with the US, in particular Mexico, are more vulnerable to increased trade barriers. A more protectionist US stance could reinforce the already slow growth of global trade. The short-term fallout of Brexit on the UK economy has been limited to date, due in part to the accommodative monetary policy response. The longer-term impact remain unclear, as the terms of withdrawal are still to be negotiated, and there are concerns that a delay in clarity could undermine investment. The Eurozone is expected to continue with its slow but steady recovery, and the Japanese economy continues to battle with deflation. Global inflation remains generally benign, and since the previous meeting of the MPC, a number of countries have loosened monetary policy. Expansionary policies are expected to persist in the Eurozone, Japan, and the UK, despite emerging inflation pressures in the latter. By contrast, a persistence of significant outflows from emerging markets in response to the possibility of tighter US monetary policy stance could pose challenges for monetary policies in a number of these economies. These new global developments are impacted on the domestic bond and foreign exchange markets. The rand appreciated steadily from the middle of October in response to some positive domestic developments as well as inflows from a large M&A transaction. The currency was trading at around 13 rands 20 against the US dollar just before the elections. It then reached its weakest point of 14 rands 60 against the US dollar in the wake of the surprise outcome before recovering somewhat. Domestic long bond yields, that is the R186, initially spiked by about 60 basis points, but the increase has since moderated to about 25 basis points. Since the previous meeting of the MPC, the rand has depreciated by about 5.7% against the US dollar and by about 1.1% on a trade-weighted basis. The rand is expected to remain sensitive to changes in the stance of US monetary policy. A US rate increase is generally expected in December and probably largely priced in. But of greater significance for the rand will be the signals from the FOMC regarding the trajectory of future rate increases. The rand will also remain sensitive to the sovereign ratings announcement due later this month and in December. On the positive side, the rand has been given support by generally improved trade account in recent months. However, the deficit on the current account of the balance of payments is expected to have widened in the third quarter of this year. The financing of the deficit may become more challenging should the recent significant non-resident sales of bonds and equities persist. During October and month to date, non-residents have been net sellers of domestic bonds and equities to the value of 42.7 billion rand and 19.7 billion rand respectively. The domestic economic growth outlook remains subdued, although the low point of the cycle appears to be behind us. The bank's forecast remains unchanged at 0.4% for 2016 and 1.2% and 1.6% for the next 2 years. Whilst the estimate for potential GDP growth was revised down marginally to 1.3% and rising to 1.5% by 2018, the output gap is expected to remain negative over the forecast period. The bank's composite leading business cycle indicator improved in August and September, continuing a recent generally positive but gradual upward trend. Available monthly data suggests that growth in the third quarter is likely to be positive, but well below the rate recorded in the second quarter. The mining sector contributed positively to GDP growth in the quarter. The physical volume of manufacturing output declined despite a positive month-to-month outcome in September. The Barclays Purchasing Managers Index, the PMI, which declined further in October, has remained below the neutral 50 index point level for 3 consecutive months. The weak trends in manufacturing are consistent with the continued low levels of business confidence, despite a moderate improvement in the third quarter. More positively, the services sector is expected to sustain its positive growth rate, with the tourism sector being particularly buoyant. Consumption expenditure by household remained subdued, with declining retail trade sales and static wholesale trade sales in the third quarter of this year. Although new motor vehicle sales increased sharply on a month-to-month basis in October, a sizable portion of this is attributed to car rental companies, and challenging conditions in the new vehicle sector persist. consumers continue to face a number of constraints. Employment growth is particularly weak. Household debt levels, while moderating, are still elevated, and wealth effects are muted amid stagnant equity and residential property markets. Furthermore, growth in credit extension to household remains subdued. Slow growth in household disposable incomes is also reflected in a gradual decline in wage growth, with growth in nominal remuneration per worker declining to 5.8% in the second quarter. When an adjustment is made for increases in labor productivity, growth over 4 quarters in nominal unit labor costs measured 5.1% in the second quarter. The Andrew Levy Employment Publications Survey reports an average wage settlement rate in collective bargaining agreements of 7.5% in the first 3 quarters of the year and 7.1% in the third quarter. This may be indicative of wage settlements becoming more sensitive to the persistently high unemployment rates. According to the Medium-Term Budget Policy Statement, the MTBPS, released in October, fiscal consolidation is set to continue at a measured pace. A moderate degree of slippage is expected in the near term as tax receipts are negatively affected by the economic slowdown. In order to prevent an excessive widening of the fiscal deficits, the MTBPS proposed a reduction in the expenditure ceiling and tax increases to be announced in February. A revised deficit of 3.4% of GDP is expected in the current fiscal year and steadily narrowing to 2.5% of GDP in the 2019-2020 fiscal year. Food price inflation remains a significant driver of inflation and is sensitive to continuing drought. While food price inflation is still expected to moderate from early 2017, the pace of decline is expected to be slower than previously forecast. This has led to an upward revision to the food price assumption in the forecast during the outer quarters in particular. The change is mainly due to the delayed impact of meat prices, which are now expected to peak only in early 2018 as farmers rebuild their herds during 2017. Brent crude oil prices reached a year high of $52 per barrel in early October, following the OPEC agreement to curtail production. Since then, prices have declined following doubts about the prospects of an agreement on the distribution of production cuts across the cartel. Some price volatility is expected in the short run as negotiations on production cuts continue. The bank's forecast maintains the assumption of a moderate upward trajectory of international oil prices over the forecast period. The domestic price of 93-octane petrol increased by a cumulative 88 cents per litre in October and November, with almost all of the increase due to higher international product prices. The current over-recovery indicates that should current trends persist, about half of that increase could be reversed in December. The MPC is of the view that a high degree of uncertainty surrounds the nature and timing of possible policy changes emanating from significant developments in the global economic environment. This elevated uncertainty creates a more challenging environment, especially for emerging markets, as evidenced in the recent changed pattern of capital flows. Financial markets are thus likely to remain volatile for some time. Since the previous meeting of the MPC, the inflation forecast have remained largely unchanged. Whereas the risks to the inflation forecast were previously assessed to be more or less balanced, the committee now assesses the risks to be moderately on the upside. This is mainly due to the possible impact of adverse global developments on the exchange rate. The risk of domestically generated shocks to the exchange rate also remain. Nevertheless, despite its high degree of volatility, the rand has displayed relative resilience in the face of numerous shocks over the past year. The domestic growth outlook is unchanged and remains constrained against the backdrop of weak business and consumer confidence. The risks to the growth forecast are assessed to be broadly balanced. Domestic demand pressures remain weak, and consumers are expected to remain under pressure for some time. The MPC has accordingly decided to keep the repurchase rate unchanged at 7% per annum. The decision was unanimous. The MPC remains concerned about the inflation trajectory, that the inflation trajectory is uncomfortably close to the upper end of the target range. Furthermore, the uncertain environment and moderately higher risks to the inflation outlook require continued vigilance. Whilst the committee retains the view that we may be close to the end of the hiking cycle, there may be a reassessment of this position should the upside risks transpire. Thank you very much for your attention. As usual, let us move to the questions and identify yourself and the media house that you represent, and we shall deal with your questions accordingly. Right here in the front. Miriam. A microphone, please.
Hi. Okay. Yeah. It's Mariam Issa with Finweek. I have two questions.
With Finweek?
Yeah. I have two questions. One is, if the U.S. raises interest rates more aggressively, could this have repercussions for us in terms of leading to more rate hikes in the future? And my second question is, you spoke of the possibility of negative fallout from rating downgrades. Have you got any projections on what this fallout could be? There's talk that the bond impact could already be priced in, but markets tend to get ahead of themselves, and if they start speculating on further downgrades, is there a risk that bond yields could rise further?
Thank you. Any other question? Yes, ma'am.
I'm Khelang Bata from Bloomberg News. I'm not sure if this question was asked already, but was a rate cut discussed at all?
One more in this round. Hillary?
Hilary Jaffe from Business Day. Governor, what is the committee's assessment of whether a possible downgrade by one or more of the rating agencies has already been priced in by the markets? And has the bank looked at what the impact would be of a local currency downgrade by the one rating agency, even if not a foreign currency downgrade? Thanks.
Okay. U.S. rates being raised aggressively, what would be the repercussions for South Africa? As we had previously said, we do not follow pound for pound or basis point for basis point what the U.S. does with its policy rates. We started our tightening cycle much earlier to deal with the inflation challenges that South Africa was facing. This time is no different. We will assess what a U.S. rate hike means for South Africa. And as usual, we have got to be guided by whether that rate hike is fully priced into the current financial markets or is not fully priced. If it is fully priced, then you would expect that the markets will say it's a no-brainer. But to the extent that it is not fully priced, there will be a reaction should there be a rise in rates. And for us, we had identified that if the U.S. raises rates because they believe that the U.S. economy has recovered, is strong, is creating jobs, and that prices in the U.S. are beginning to rise, that is good for the global economy. And if it's good for the global economy, surely South Africa should benefit from a global economy that is performing well. We also expect that should the U.S. raise rates, there will be a repricing of within the financial markets to the extent that that pricing is not fully factored into financial markets. But we have also seen in the run-up to the FOMC meeting and the developments in the U.S. of a dollar that is strengthening against other currencies. So you are seeing a global realignment of exchange rates, and the rand would also realign within that context. And of course, in that realignment, if the rand ends up being weaker, we faced with two situations. We could treat that as a once-off shock, if it is a once-off shock. And if it does lead to a situation where generally prices in South Africa begin to rise as a result of a depreciation of the currency, in other words, leading to second-round effects, then policy is then going to have to respond to deal with the second-round effects. So put simply, policy will not be responding because the U.S. has raised rates. Policy will be responding to the consequences of the rise in U.S. rates. Was the possible fallout from you said a ratings downgrade? I say a possible ratings downgrade, because at the moment it just remains a possibility. The situation in South Africa, the fundamentals in South Africa are different from the last time the rating agencies had put us on terms, which is why when they did the previous review, they decided to keep our rating the same. Be that as it may, putting your case to the rating agencies is one matter. The other is that the rating agencies' decisions are taken by ratings committees. So we shall await what the rating committees decide, and to the extent that the possibility of a downgrade is factored in current financial market prices, then a downgrade will be a no-brainer. But to the extent that it is not priced in and it takes place, you will expect a repricing in financial markets. On the other hand, if the financial markets have priced in a downgrade and the downgrade does not take place, we would expect that there would be a positive repricing in financial markets as well. To what extent do we, Hilary, to what extent have we worked this thing into the pricing? Difficult call to make, because there are players who would take a view that there is going to be a downgrade, and there are players who will take that there will not be a downgrade. That is the beauty of an efficiently functioning market, because views get to contest, and those who got these things wrong, they pay the price for getting them wrong, and those who get them right get rewarded for getting the pricing right. Local currency downgrades, you are aware that the local currency rating is higher than the foreign currency denominated rating. And for the purposes of the domestic bond market, what matters is the domestic currency rating, because that's what feeds into the world bond indices that take account of which bonds to include in those respective indices. Even if there was to be a downgrade on the local currency denominated ratings, we do not expect that that would drop below investment grade, because there is such a big cushion. Well, should it take, it would happen, it will be a big shock, but we do not expect that to be happening. Shall we take the next round of questions? Whether a rate cut was discussed or not. You said that you don't know if the question was asked before. Nobody asked it. I guess they reserved this question for you, Amukela. No, it was not discussed. Remember from the previous meeting, we said that the bar for any future rate cuts have been set very high. We do not think that that bar had been scaled yet. Shall we take the next round of questions? Seppo.
Good afternoon. Governor, I just want to find out, in the latest round of discussions with the rating agencies, if the bank has met with the rating agencies, and what was the tone of discussions that may have taken place. And then the second question is, you're mentioning that domestically we might have reached a low point in terms of growth. Does it mean that at 0.4% you think that the economy cannot go any lower?
Arabil.
Good afternoon, Arabile Kumete, Bloomberg News. Governor, the shocking win by Donald Trump, how did that play into an exact decision by the SARB, and did the effect of what happened to things like the rand and bond yields also play into your decision?
Do you want to put your questions together? Okay, go ahead, ma'am.
Xola Potelo from Bloomberg News. Governor, I wonder if the bank is concerned by the IMF's recent assessment that the rand is one of the three most vulnerable currencies to further weakness just in emerging markets generally because of the level of reserves that South Africa holds.
Because of?
The level of reserves. Does that concern you, and if so, what do you plan to do about it?
Miriam?
My question is more of a financial stability question. As far as we know, the President is still sitting with the amendments to the FICA bill on his desk, which have been approved by Parliament. If these don't get signed into law, what might be the repercussions for financial stability here, if any? And is there any urgency about them being signed soon?
Okay. Deputy Governor Naidu, FICA bill, Mr. Minele, vulnerability of the rand and the discussions you had with the rating agencies and the tone. Rashad, the growth point, this being the low point, and yeah, Brian, it was you who was in the US, so you can tell us about the Trump decision. Who wants to go first? Who's ready?
Let me start with the question from Tsepo. Yes, we would meet with the rating agencies when they are in the country to do the assessments, and meet with various constituencies and people in the private and obviously the public sector. The tone of the conversation, they're very nice people, so the tone is normally very friendly, and they ask the questions that they need to ask. We give them an update in terms of our assessment of the domestic economic situation, obviously with a lot of focus on issues that pertain to the work of the central bank. From there, they take the information and process it and take it to their ratings committees. And when they're ready, they then give us the the results of their evaluation. But the conversations are normally happen in a very orderly and very friendly manner, so there's no aggressiveness or anything that one might be able to discern from the way they ask their questions. These are very normal and cordial conversations, and very difficult to discern from those conversations what the decisions might be. So we provide the answers, we have discussions with them, and then await the outcomes of their decisions. With regard to the question around vulnerability based on the level of reserves, I think we ourselves have for a while been indicating that while our reserve levels have improved quite significantly in recent years, certainly if one compares that to periods where on a net basis we actually had negative reserves, they have not improved to levels that we ourselves would be comfortable with, and we do believe that a higher level and a higher cushion in terms of foreign exchange reserves would help in strengthening the external resilience of South Africa. However, if one looks at the various measures that tend to be used in assessing reserve adequacy, whether it is measures that have to do with weeks of import cover or relationships with regards to short-term debt, we tend to actually satisfy those measures. It is just when one compares us with other emerging markets of similar size or economic structure, we tend to be on the low side. So as we have ourselves previously said, we will utilize any opportunities that present themselves when market conditions are conducive to continue increasing our reserves. And if one looks at our monthly notice of foreign exchange reserves from the most recent one that was published earlier this month and from the previous month, you may have noticed that we made some progress given opportunities that presented themselves during the period. Thanks.
Thank you, Governor. We are concerned about the potential impact of the delay in the signing of the Financial Intelligence Centre Amendment Bill on our banking system and the financial sector. I wouldn't describe it as a financial stability risk, but there certainly are concerns. In 2000, South Africa is a member of the FATF, the Financial Action Task Force. In 2008, they did an evaluation and published a report in February 2009, setting out various recommendations that South Africa has to meet in order to remain compliant with the FATF recommendations. There were several of those recommendations that we were not compliant on. One of those was a legal obligation on the banks and other financial institutions to do enhanced due diligence on certain types of people, transactions, or banking relations. The Financial Intelligence Centre Amendment Act expressly attempts to give effect to that recommendation. If we have not complied with these FATF principles and recommendations, next year there's an evaluation that FATF will do, and if they find that we are not compliant, they could issue what would be called a statement of non-compliance. That could have negative impacts for the South African financial sector, depending on how it's interpreted. I think we're a long way off from being cut off from the global financial system. The initial step would be to list South Africa as a jurisdiction that has not fully complied. That may require other foreign banks to increase their due diligence on South African banks and South African transactions, which I think will have a negative impact on our financial sector.
Thank you. The question as to how we factored in the impact of the US election outcome on our, how we factored it into our decision. You know, as we explained in the statement, it was quite clear that there was an immediate impact on the rand and on the bond markets. But the impact is really highly uncertain. If you look at what happened in the US markets, the initial impact was very negative for the stock market and for the currency and for the dollar. And a few hours later, the markets changed their minds and decided, well, this was going to be growth positive, and we saw the dollar strengthening, equity prices going up, and expectation of tighter U.S. monetary policy coming out of that. But the markets have been very reactive and probably overreacted. We saw the rand going from 13.20 to 14.60, and now it's back to 14.20. The bond markets went up by 60 basis points and down now to, as we said, about 25 basis points higher. So it is very uncertain what exactly the policies are going to be. And we think there's going to be a lot of uncertainty and a lot of speculation about those policies. So it's extremely uncertain. The way we factored it in, we believe that the risk to the exchange rate is probably a bit higher than it was previously, but clearly not sufficient to change the stance of monetary policy. But it is something that we will be watching very carefully.
Tsepo, your question on growth, as you know, that us and many other central banks over several periods have underestimated how bad growth is. So we have, for a series of meetings, as you know, until the last one, revised growth downwards. We were pleasantly surprised when we revised growth upwards, as you know, from 0 for 2016 to 0.4. I think that whether we've reached, whether that gets revised lower down again will really depend on the next 2 quarters. Our forecast of 0.4 assumes that there's going to be really moderate growth in the 3rd and 4th quarter. When I mean moderate, growth under 1% for both quarters, well under 1%. If for some reason, we see no growth and we're surprised at the next GDP and the one after, it's not inconceivable that we could be revising downwards again. But I think that, I think that, we're pretty confident that this time, we could come back and give you a different story, but we're pretty confident at this time that, that 0.4% is about right, and I think that's where things stand.
Any other questions? Tsepo.
Governor, based on your labor your assessment of labor output in average in the country, what's your take on the proposed minimum wage of 3,500? Do you think it's something that we can adapt and would bode well for the labor market and wages?
Miriam.
Thank you, Governor. You made it clear that the decision today had been unanimous. However, was there any discussion of a rate hike?
Hillary?
Last December was a rather turbulent time in South African financial markets. I was wondering whether you have any special arrangements in place in case of any turbulence this December.
Arabil.
Governor, they say ladies first, but in this case, I'll take it. Just going on with his question, do you believe that, do you have any thoughts on whether that agreement may have inflationary impact, which will then obviously affect the Reserve Bank's decisions moving forward?
Governor, you've said that the rand has remained quite resilient in the face of numerous shocks this year. Do you expect that that will persist going into the next year, especially given that we have outflows? You also pointed out in your speech that the current account deficit may become more challenging to finance given the recent significant non-resident and bond and equities sales, if those persist. So do you envision that the rand will remain resilient even if there are more shocks that come through?
Good. Mr. Minale, you're resilient about the rand, so I'm going to bring that back to you. Special arrangements for December. Yes, we do compile a roster in the Reserve Bank about who takes leave when, so that there is always somebody keeping the institution running. We always plan for contingencies, and it doesn't have to be December. So whenever the executives have to do anything, whether they are traveling for business or they are going on leave, we always make sure that the people here who keep the institution running. So if something happens in November or in December or in January, anytime, we are ready to deal with the contingencies. Was there any discussion of a rate hike? There was no proposal for a rate hike. The discussion had to do with the current economic developments, and based on the current economic developments, every member felt that we should actually stay on hold, which is exactly what we did. Proposed national minimum wage and the inflationary impact that is Arabic thing. I will come to that. Let Mr. Minero to deal with the resilience of the rand and the current account deficit and the capital flows that have to do with it.
The Amrala is a difficult question. That I think what we're referring to with regard to the rand having been more resilient recently had to do with the level of volatility, certainly when compared to other emerging market currencies, that has tended to be less. But you will note that essentially what pervades our entire statement is around heightened levels of uncertainty. And I wish I could tell you whether the rand will remain as resilient given the various factors that we've talked about. We will have to see. It's a very difficult thing to predict. I can tell you what I wish for, but I'm not quite sure I can tell you what exactly is going to happen.
I wanted Rashad to deal with the national minimum wage, but he looks worried. Let me say that there is policy with a big P and policy with a small p. So once you have decided you're going with a national minimum wage, that is a big policy question. Policy with a small p has to do with the actual design. At what level do you pitch the national minimum wage? What exemptions do you have? Do you have it in combination with sectoral minimum wages, or do you have it on its own? All of those determine in the final analysis what the impact of the national minimum wage is. We have not seen the full details of the final package of how that national minimum wage will look like. Once we have seen that, we will analyze, and then we will take a decision about whether it, what its impact would be on inflation. Let's suppose that it's just a level and it's imposed once. You treat it like any other shock. It's a once-off shock, right? But since it's a national minimum wage, again, policy with a small p, the decision is also going to be how frequently do you adjust these things. We do not have all of that information, and it's difficult for the bank to assess and say to you, this is what we think the economic impact would be. Is there anybody on webcast today? This is a very good day. Any other questions? Well, in the absence of any other questions, let me thank you very much for your participation in this press conference. We will see you again in the new year. Remember, the January meeting, due to a very tight schedule, is a 2-day meeting, and the press conference will not be on the Thursday. It will be on the Tuesday. It will be on the Tuesday. So please bear that in mind. Otherwise, have a Merry Christmas and a very prosperous New Year. We will see you in January. Thank you very much.